Alright guys, Darren from Honest Money and welcome back to another video. So this week I am going to be exposing the UK government and showing you how you could be paying as high as 60% tax on some of your income. Now this is something I only discovered this morning and I was actually quite shocked that I hadn't heard about this before, so hopefully you guys are going to find this useful. So the actual tax band itself that I'm talking about does not have an official name. It's just kind of an irregularity of the UK tax system that you will end up paying 60% on this portion of your income, but for the purposes of this video I'm going to call it the personal allowance trap. Now just before I get into it, let's just lay a little bit of foundation about personal allowances. So in theory everyone in the UK should be able to earn £12,500 tax-free. At the moment this is tax year 2020-2021, it could change next year, who knows, but at the moment you should be able to earn £12,500 tax-free, and that is called your personal allowance. Anything above that, all the way up to £50,000, you would then pay 20% income tax on. Then above that to £150,000, you'd pay 40%, and if you're lucky enough to earn over £150,000, you'd pay an additional rate of 45%. So where does this personal allowance trap come from? Well, this is a screenshot that I took from the HMRC website this morning. So any income, this applies to any income over £100,000, and also bear in mind before I read this, you also need to do a self-assessment if you earn that amount of money. But your personal allowance goes down by £1 for every £2 that your income is above £100,000. This means your allowance is zero if your income is £125,000 or above. Now the reason for that is your personal allowance is £12,500, so it takes £25,000 at the 2-to-1 ratio to completely wipe that out. So in practice, how does this actually work? Well, I've put together two examples, one for someone that is earning up to £100,000 and then someone that is earning just over £100,000 to show you how this kicks in and how you could be liable for 60% tax. So up first we have Jeremy. Let's say that Jeremy earns £100,000 per year and he has a personal allowance of £12,500. So on the first part of his earnings he pays absolutely zero income tax. Up next he then has the basic rate from £12,500 to £50,000 where he pays £7,500. Then finally he has the higher rate at £20,000 and there's no additional rate as Jeremy doesn't earn over £150,000. So in total he pays £27,500 on that £100,000 income. Now this doesn't include national insurance or anything like that, so there are other taxes, so his actual overall tax would be slightly higher, but for the purposes of this video I'm just focusing on income tax. Now up next we have Boris. Now Boris earns slightly more than Jeremy, so we're going to put Boris down at £125,000 per year. Now as the previous slide explained, if you earned £25,000 over £100,000 you would not have any personal allowance left. So Boris does not earn anything tax-free, so instead what happens is the basic rate shifts. So still the same volume in the sense of £37,500, it's just from 0 to £37,500 rather than 12.5 to 50, which is the same amount. So they still pay £7,500 at the basic rate. However, what happens is because they do not have any personal allowance, that money is then taxed at the higher rate instead. So instead you're paying 40% on the £12,500 that Jeremy was getting tax-free. So in total, Boris is paying an income tax of £42,500. So where does this 60% tax come from that I'm talking about? Well, if we break it down like this, so the extra £25,000 that Boris earns should create a tax liability of £10,000. So if you taxed £25,000 at 40%, that would be £10,000 of tax liability. However, the loss of the personal allowance means that another £5,000 tax becomes due on the £12,500. So £12,500 taxed at 40% is £5,000, which means in total on the extra £25,000 that Boris earns over Jeremy, he is paying £15,000 tax on. So that's a marginal rate of 60%. So out of £25,000, he's only actually receiving £10,000, so he's paying 60% tax on that income. Just a couple of quick things before I wrap this video up. Firstly, once you get past £125,000, all of this becomes irrelevant in the sense you'd have already paid that tax and your tax rate will just go back down to 40% until you get to £150,000, which is when you will start paying 45% tax. Also, if you're like me and you're a director of a limited company and you pay yourself with dividends, your overall tax rate would be slightly different, but you'd still lose your personal allowance and you'd still be paying the applicable tax on there, just as Boris did in this example. So hopefully you guys have found this useful. If you did, I'd really appreciate it if you could take a moment, scroll down, hit that like button, and if you want to see more videos from me while you're down there, subscribe to the channel, and I'll see you guys in next week's video.